All right, so we'll understand how to use this Excel sheet, which is basically for calculating your position size when it comes to do your position sizing for the futures. So this sheet basically has two pages, and the very first one is called as SSF. SSF stands for your single stock futures, and this is the stock drop down list. So what you need to do is, because the time the sheet was created, these were the lot sizes for different scripts, but these lot sizes are not constant. At times the lot sizes, they keep on changing, so make sure whenever you're planning your trade, if the lot size has changed, all you need to do is change the lot size in front of it. If some new scripts, they get added to futures, you can add the name of the script and their lot size as well, right? So on this second page is where you provide your lot size for all the scripts, right? Now what you do here is you have to define your risk per trade. So let's take an example. Your risk per trade is 10,000 rupees, and let's imagine I'm planning some trade, and time frame means whether it is weekly income, daily income, hourly income. You can do that. So you can say, okay, I'm doing it as a daily income trade, DIT. Right. Now the next thing is the name of the script. So all you need to do here is double click and start looking for the name of the script. Let's imagine I was doing ICICI Bank, right? So I've just selected that, and can you see, as soon as you select it, the lot size is taken automatically from this sheet. So just in case if the lot size has changed, what you can do is here you can change the number in front of ICICI, and then it will be taking the the latest number, which is the lot size of that stock. Now I'll also show you how to check the lot size. What you can do is you can go to your NSE India, and once I go to NSE India, let's just wait for a few seconds for it to load up. I'll select equity derivatives, and let's say ICICI, and I'll select ICICI Bank Limited. And it is showing you that your current lot size is 2750. So can you see the lot size for ICICI has changed? Initially it was 2500, but now the lot size is 2750. So what I'll do is, as an example, I'll go to this page, and here I'll look for ICICI, find ICICI, and this I'll change to 2750, and you will see that this will get updated, and now you'll be having 2750. Now the lot size does not change very frequently, so once you have made these changes, you will see for a very long period of time it would remain static, but because the sheet was created long time back, so that is the reason I'll say, the things might have changed for the lot size. So make sure you update it when you are using the sheet. Now, let's imagine what prices ICICI is trading at, right? 318, right? So let's imagine that I'm planning a long trade on ICICI where my entry is 310 and my stop loss is, let's say, 308.25. So what this is doing is it is calculating your position size based on your risk, which is 10,000 here, and based on 10,000 risk, what it does is it gives you what should be your position size. Now, when it comes to calculating the position size, what we normally do is we just check the difference between entry and stop loss, and using that we calculate our position size. As an example, in this case, my entry is 310 and my stop loss is 308.25, which means a risk of 1 rupee 75 paise. So if I want to risk 10,000 divided by 1 rupee 75 paise, it should be 5,714 shares. But can you see here it is giving you 4651. So what is the reason behind why it is giving you a little bit less number of numbers for the quantity? The reason for that is in futures the spreads can hurt you really bad. So what this is doing is it is taking 1.75, which is your entry to the stop loss, plus also adding 40 paise into it, which will make it as 2 rupees 15 paise. And now using 2 rupees 15 paise as your risk, your position size is getting calculated, because when you get stopped out, you always get stopped out at the market price, which is where you can have some slippage. And now if I do the calculation, this is 2 rupees 15 paise, 10,000 divided by 2 rupees 15 paise, 15 paise is 4651, and that is what you can see here, 4651. So it's basically taking your risk plus the spread, and then the position size is getting calculated. Now, the way this sheet basically works is it tells you three different ways. Can you see we have three different colors? So three different ways how this trade can be done. The first way is you can round down your risk, right? By rounding it down, because we know that the lot size is 2750, right? And I can now only trade in multiples of 2750. Therefore, you can either do one lot. If you're doing one lot, you will only be risking 5,900 rupees, though you are allowed to risk, let's say, 10,000 rupees, right? But you're only risking 59. So the second thing it does is it also tells you if you're rounding it up, which means that instead of one lot, if you do two lots, you will be losing 11,825. But if this number was very, very close to 10,000, right? Let's imagine if this number was 10,100 rupees, maybe 10,060 rupees. So that is the time I could have rounded up, because 50, 60 rupees difference doesn't make a very huge difference when it comes to your risk management. But 11,800 is definitely a very big difference. So I would not prefer to do two lots, right? Because I'll be increasing my risk from 10,000 to 11,825. And similarly, I would also not like to do one lot, because if I'm doing one lot, it's almost 50% of the risk which I'm taking. I'll say 60% of the risk which I'm allowed to do. So now I can use the third option, which is your second entry. So what do we mean by second entry? That you can do one lot at this price, but the second lot you can do at 309.35. And you know that if you're doing this entry 309.35, you're going 30% deep into the zone. So if your rule says that I don't want to take trades which are more than 50% deep, then you can, have your second entry as well. So you can place one order at your original price, which is 310, and the second order at 309.35. So if the prices, they go a little deeper into the zone, you get two lots, and now your risk is still constant at 10,000 rupees. This is rounded up. So what you're basically doing is, instead of one lot, now you're doing two lots. You are increasing your risk, and by increasing your risk, you will be taking the risk of 11,825, right? And the number of shares, or you should be doing now, is 5,500, because it is two lots. So it would be 2750 into two, which is 5,500. If you're doing double entry, then you can do one entry, which is 2750, one lot at 310, and the second lot 2750 at 309.35. And then this would be your target one, and this would be your break-even point. And similarly, if you're rounding it down, then you can only do one lot, which is 2750. And the stop loss would be whatever our original stop loss was. And then you also have your break even in the target one. Right, so it gives you all three choices. Choice number one, you can round up. Choice number two, you can have one entry at the original price, and whatever one leftover lot is would be a little bit deeper. And the last one is that you just take the original entry and you are just reducing your risk on that trade. So this is what this Excel sheet basically helps you with, to calculate your position size in futures, right, based on whatever your risk appetite is. So now you know how to use this sheet, right? And let's close this.